Now, I'm a currency trader. That's my specialty. That's what our firm does, and that's always been my favorite market because of the way they trend. Here's a forecast I made for the dollar. And I know, there's no cash currency vehicle to trade, but there is a futures contract out. But we look at the dollar index because it's a basket of many different top currencies. And it does provide a guidepost for our overall strategy. Back in 2001, the dollar topped, had a nice wave 1, first wave down, wave 2 pullback, and then this big wave 3, then a wave 4 pullback. So again, wave 3 is the biggest, and even wave 3 subdivides 1, 2, 3, 4, 5. Wave 4 pullback should go to the old wave 3 or possibly to the wave 4 high. Here's the thing I want you to know. I made a forecast on August 6th, 2004, that the market would do one of two things. Either go up in this direction, which is not my preferred wave count, or would pull back, bottom in 2005, and then have a nice sustained run, which it did. So right in here was either here or here on this forecast we just experienced, this low. Within the next few days, we're going to tell whether this forecast is going to be good for the next 3 to 12 months. And that's really what we're going to get into tonight. So this is really gives an idea that the dollar should strengthen, whereas everybody's talking about the euro going much, much, much higher. But I don't think it's going to do so just yet. And I don't think the dollar is going to crash just yet. But there is one caveat, which I'll share with you. So I believe the best preferred wave count, is what I call it, is that we're somewhere either in this low or in the secondary low within the U.S. dollar against all the world major currencies, and that we're going to experience a nice counter trend move that will take it back to the previous wave 4, or possibly a wave 4 here of what we call lesser degree. So we're looking for a move back to 85, or possibly as high as 98, but more likely about 92 in the dollar index. And you can take a look at that in the futures. The symbol is, DXM5 would be the June futures, or DXY is a dollar index cash. It's like stockcharts.com has that. Here's what happened. Here was where I made the forecast for a little rally, and then a sell-off, and then another rally, and possibly one more sell-off. Here's where we were as of Friday or Sunday early a.m. Let's go back to the forecast. Here was the low, and then the rest of the forecast. I forecasted a bounce, a sell-off, and then another bounce, and hopefully this rally. And then here's what happened. The low, the rest is this was all forecasted, almost identical to what happened, because of my knowledge of Elliott waves and other aspects. Here we are. We're at the 50-week moving average and some trend lines. So the dollar right now, for all you self-traders out there, and for people interested in our program, it's at a real critical juncture. From here, it's either going to take out this low below 82 and hopefully go no lower than 78, 78.41 to be exact, and then experience a major rally, or it will just have a slight pullback in here and then begin its a very nice substantial correction up into the 90s, possibly as high as 98. This old fourth wave pullback high. 1, 2, 3, 4, 5, and then a bigger wave 4, and finally a wave 5. So there still allows for one more new low on the dollar index, but it doesn't have to. This would be wave 1, 2, 3, 4, maybe a failed with fifth wave. Here's the final alternate count on the dollar index. If it rallies here, which it did, and it happens to take out 78.41, there's a remote possibility that the dollar could crash, which I ultimately expect it will, but not just yet, hopefully. So you can take a screenshot of that if you want. Dan can send you this But hopefully that scenario will not play out, and this scenario instead will play out. Will give us a lot longer to take advantage of this moves. Okay, recent example again. I believe for Friday or possibly very early in the morning Sunday. So either the April 1st or April 3rd. And this is a monthly chart of the Australian dollar. We're going to go in alphabetical order and cover some markets. This is the 1986 low. So this is a 18-year Andrews median line. So what I do is this. I find a known bottom and the next alternating known high and the next alternating known low, and I'll draw a line from here across, and I'll bisect it. I'll show you a better example here. And this line will pick the trajectory of the market. And it picked this top, and it picked the most recent high. Now I can tell if my analysis is correct because you see how here at the bottom in 01, I drew the lines, literally I started drawing these lines back then. But when it reacts, takes a rally, and it holds on that line. Remember, this is a hypothetical line that the markets don't know about. But if I could have drawn this line right here at the bottom in 2001, and this was valid because it tested the line, and I say it held market structure. So my analysis was supported by the market structure or contained the market structure, which is extremely powerful. And I had a good idea that once this low held and took out this high, that I could have a move that ultimately would take the Australian dollar from 50 all the way up to 78 and 80 area, which is amazingly powerful. There's nothing like it. So I'll show you greater ideas of how you can utilize that for your your own mutual fund portfolios or whatever else, or to tell if we're doing our job properly. Here's a weekly chart of the Australian dollar. And we have a double top and a little wedge formation. And what else do we have? Well, we got a nice five-wave pattern. 1, 2, 3 the biggest, 4, 5, and that's this big wave 3. Starts here 1, 2, big wave 3, 4, and wave 5. And even wave 5 goes 0, 1, 2, 3 the biggest, 4, 5. And even this little wave goes 1, 2, 3, 4, 5. So our system, recognizing this pattern, sold the Australian dollar short right up here at like 78.80. This is a weekly chart. And we covered our first little profit objective at 77 and change. Ultimately, I think the Australian dollar should go back to the fourth wave of lesser degree back in the May lows of 69. So we're expecting a nice move down here. As long as it doesn't take out the old highs, we'll be trading this continually on the short side, even though we might get a little bounce here. Here's the daily resolution. Again, wave 1, wave 2, 3 the biggest, 4, and then finally 1, 2, 3, 4, 5 waves up. Now notice we've got a nice wedge pattern, and a rising wedge is bearish. So not only do we have a nice 1, 2, 3, 4, 5 Elliott wave structure, this fifth wave is very low momentum. We've got divergence on the indicators, which means the market's making a new high. The indicators are not making new highs. Here, the stochastics and commodity channel index, CCI, did not make a new high. Matter of fact, it made two lower highs, which is very bearish. And here's right where we sold the market, right here, like 2-3 days after the high. Covered it right over here with our profit objective on our trading system, and now a little rally. If it breaks this low here at 76.50 more or less, this pattern projects down to 72.50, 72.20 area. So that's about $5,000 a contract, or $4,500 per contract, which we would expect our system to catch probably about half to 2/3 of that move. Here's a long-term forecast on the British pound. Now I give three examples of what it should look like. Not that I'm throwing darts here at all, but depending on what the market does, I will have a very good idea of which forecast is going to be the most likely. Right now we're expecting a pullback in the euro currencies. And this, I actually think the pullback's more likely to look like the secondary forecast here. So a nice pullback in the European currencies to this previous fourth wave, and then a blast off in the pound against the dollar and the euro against the dollar. It may be that the forecast goes the opposite with this other forecast, but when it gets there and when I have the new high and low swing points, I can draw my analysis, my Andrews line, and I create something called a market structure map, a strong gauge for which way the market should go and what it will look like. But there's no other way that I know of that will allow us to make these kind of extraordinary forecasts by not having all this information, both the Elliott wave and these Andrews forecasts. Again, here's a known low, here's a known high, here's a known low. Draw a line through that, bisect it, and create upper and lower parallel channels, and bingo, I know that's a good analysis because it held right on that channel, and poof, fantastic, takes off. Very, very powerful. Okay, just what happened recently. The European markets topped in December and some in January, I believe, but right around the beginning of the year, you'll notice if you look at the foreign exchange charts, they tend to make major moves either in December or in January. They, for some reason, they change trends right around at that time. We've been watching that for years. Here's an analysis technique that was drawn, possibly indicating a top at 93 area at the intersection of what's called a midpoint line. And that is, here's a low, alternating swing high, and an alternating swing low, and yet I don't expect it to make a new high. So I take the midpoint from these intersecting lines. This is called the midpoint line. There was the midpoint of this swing. And I draw a line through this next swing right here. This is done by the computer, by the way. And it gives me the forecast for a corrective move. The market's not going to make a new high, and if it's a correction, it's going to stop on the midpoint line, which it does almost to the tick. And also from this new dark Andrews box, which is made off this high, this low, and this swing, and it's bisected through this imaginary line. So when the market tagged those 2 points, we had a very strong resistance, and it forecast a move down to 87 or possibly down to 82. And let's see what happened. We also had divergence on the indicators here. So here was the forecast of a resistance, major resistance point. Again, midpoint line, going from the midpoint of this swing to the midpoint of this swing, capturing this this particular high, and then we were immediately able to draw a new Andrews pitchfork. The market held, market structure right here, and then 1, 2, 3, the biggest, 4, 5. And here's probably another level for correction. So we actually sold this with our system, sold this market, caught this short. We went long right here. It didn't reach our profit objective, which was actually 91.70, I think it is. Stopped on this median line, which is high, low, high, swing right to the middle, stopped right on it, sold off. So we're still long, and we actually may get stopped out on this one, but we caught a nice, very, very nice move there and almost caught the low for our profit target. We won't catch every single move with the system, but it's highly accurate relative to most systems. Most systems are 45, 50% accurate, and our system used to be 45 to 55% accurate. Now it's running at 60 to 80%. Matter of fact, in February, I just checked one of our larger accounts. It was 72% accurate for our trades. Here's a big picture of the euro. Monthly chart going back to 1986. Last known swing low, last known high swing high, last known lowest swing low, draw a line through the middle. Bingo, it picks the top at 135, 136 area, which we just had. That's very strong resistance. Why do we think there's a chop here? Well, let's try to look at the market logically and very objectively. Here's a wave 1, wave 2, then a gigantic wave 3, which subdivides 1, 2, 1, 2, 3, 4, 5. Another wave 4 pull back to the top of wave 3 or the bottom of wave 4 area. And then 1, 2, 3, 4. So this is either a wave 4 or it is a fifth wave top. At no time now in the next year would I expect the euro to go above 145. And preferably we'd like to see it go to 126 first, which is this median line here. Again, high, low high, draw a line through the middle, which is this 124.60 area target, or possibly down to this lower line, which would be 116.114 area. So that's really what we're looking for right now, and that has the highest confidence level for a forecast for us right now. Notice how on this area you're rallied right from this low, tested the this lower pitchfork, rallied again, tested it again, very strong support and very high confidence that the market would run all the way from 86 where this low was all the way to 136, 135 area. There's one thing I want to add. There's one lower swing low point way back here, I think in 1985, 84, that actually has a line going up to 145. So, and I do expect that to eventually be hit after this pullback. I think there'll be one more major rally in the euro. Here we are on the weekly charts with the euro. Again, there's wave 1, wave 2. You can see 1, 2, 3 the biggest, 4, 5. Even this 1, 2, 3, 4, 5. And then even look at wave 5, 1, 2, 3 the biggest, 4, 5 low momentum. Where should it pull back? To the fourth wave of lesser degree, or the top of wave 3. So it pulls back to the top of wave 3. And where did this one pull back? It pulled back to the wave 4 area. It's amazing how this works. Here's another one, the recent top, 1, 2, 1, 2, 3, 4, 5, and it pulls back, and a little correction. We may make one more high right here, but we're at that same place on the dollar index where we're at real critical support and resistance in all the markets. So here we are at Friday or Sunday morning, and whether it breaks here or rallies back up and make a new high, we'll know very shortly. We're actually going to get a buy signal here on our system probably tonight. Here's what it looks like on a daily resolution. Last known high, last known low, last known high, line through the middle, and this was Friday night, Sunday morning, looking for a pullback to a final target in here somewhere in the 128 area. There's other lines here that you cannot see. And then, which the euro just tagged a low at 127.80 or something like that and rallied. So we think that's probably a good low for now. A couple other markets. Here's a monthly chart of the yen. Again, more teaching for you. Here's a wave 1, wave 2, wave 3 the biggest, wave 4 to the old wave 3 pullback. I mean, old wave 4 high, 1, 2, 3, 4, 5. And then finally, the final wave 5 low, which is less steep. Wave 3 is very steep. Wave 5, less momentum. Lots of divergence on the indicators compared to this low. And then a big A, B, C correction. And what do we expect here? Since this is a gigantic move, the market still has potential to make it up to 160 here, which would be a gigantic move. And it's supported by this line, this pitchfork here. If the yen takes out this low below 100, then this forecast to move to possibly 130 to 150 will be negated, and then we'll look for much, much lower lows in the dollar end. But for now, we have reason to believe that it'll go to 110, 108.50, 110 to, I think it hit there today actually, to possibly